Listen, something extraordinary is happening right now in the financial markets, and if you're retired or approaching retirement, you need to understand what's unfolding because it's going to determine whether you preserve your wealth or watch it evaporate over the next few years. We're witnessing the early stages of the largest wealth transfer in modern history. Not tomorrow, not next year. It's happening right now, today, as I'm recording this. And the vast majority of retirees have absolutely no idea it's coming. Let me paint you a picture of what I'm seeing. In the last 18 months, central banks around the world have purchased over 100 metric tons of gold. That's the highest level of accumulation since 1967. Think about that for a second. Central banks, the institutions that print money, are dumping their own currencies to buy gold at a pace we haven't seen in nearly 60 years. Why would they do that? What do they know that you don't? Here's what's really happening. The global financial system is undergoing a fundamental restructuring. The dollar's dominance as the world's reserve currency is being challenged in ways that seemed impossible just 5 years ago. And when that dominance erodes, when countries start settling trade in currencies other than dollars, something has to absorb all those excess dollars floating around the global system. That something is going to be hard assets. Gold, silver, real things with intrinsic value. But here's where it gets interesting for retirees specifically. You've spent your entire life building wealth in dollar-denominated assets. Your 401k, your IRA, your pension if you're lucky enough to have one, your savings accounts, your bonds, everything is priced in dollars. Everything depends on the dollar maintaining its purchasing power, and that purchasing power is being systematically destroyed. I want you to think back to 2020. Remember when the Federal Reserve printed more money in a single year than in the previous century combined? They created over $5 trillion out of thin air, just conjured it into existence with a few keystrokes, and they told us it wouldn't cause inflation. They told us it was transitory. Well, here we are in 2025, and your grocery bill has doubled. Your insurance premiums have skyrocketed. Your property taxes keep climbing. That fixed income you retired on? It buys about half of what it did 5 years ago. This is the hidden tax. This is how governments default on their obligations without actually declaring bankruptcy. They inflate away the debt. They inflate away your purchasing power. They transfer wealth from savers and retirees to debtors and the government itself. But some people saw this coming. Some institutions positioned themselves ahead of time. Let me tell you about what happened in Singapore last year. The Monetary Authority of Singapore, their central bank, quietly increased their gold reserves by 47% in a single quarter. Not over a year, not gradually. In 3 months, they nearly doubled their gold holdings. When I saw that data, I started digging deeper. What else were they buying? What were they selling? And the pattern became crystal clear. They were dumping U.S. Treasury bonds and buying gold. Lots of gold. Singapore isn't alone. China has been reporting gold purchases every single month for over 2 years now. But here's what most analysts miss. Those are just the official purchases they're reporting. Intelligence estimates suggest China's actual gold reserves could be 3 to 4 times higher than what they publicly acknowledge. Why would China hide their gold purchases? Because they don't want to trigger a panic. They don't want to alert the market to what they're really doing, which is systematically reducing their exposure to dollar-denominated assets while accumulating the one asset that's been money for 5,000 years. Russia took this strategy even further. After 2014, they went on an absolute gold-buying spree. They sold off nearly all their U.S. Treasury holdings and converted the proceeds into gold. By 2020, gold made up over 20% of their total reserves. When Western sanctions hit in 2022, guess what happened? Their currency stabilized because it was backed by real assets, not just promises. Now, I'm not suggesting you need to agree with these countries' politics or policies, but you need to understand their actions. These are sophisticated financial institutions with access to the best economic data and analysis in the world. And they're all doing the same thing. They're all moving away from paper assets and into hard assets. The wealth transfer I'm talking about isn't some abstract economic theory. It's the movement of purchasing power from people holding paper assets to people holding real assets, from people trusting the system to people who prepared for the system to change. And retirees are uniquely vulnerable to this transfer because you can't just go back to work and earn more income. You're living on a fixed amount of capital that needs to last the rest of your life. When that capital loses purchasing power, you can't replace it. I've been analyzing precious metals markets for over 15 years, and I've never seen a setup quite like this. Every single fundamental indicator is pointing in the same direction. Supply is constrained. Demand is accelerating. The paper market is showing signs of stress. And the smart money is positioning aggressively. Let me break down what's happening with supply first, because this is critical. Global gold mine production peaked in 2018. Since then, it's been essentially flat or declining slightly. The easy gold has been found. The high-grade deposits have been mined. What's left requires going deeper, processing lower-grade ore, and spending more money to extract each ounce. The average all-in sustaining cost for gold miners is now around $1,300 per ounce. That's what it costs them to pull it out of the ground, process it, and bring it to market. With gold trading around $2,700, that sounds like a healthy margin, right? But here's what most people don't understand. Those costs are rising fast. Energy costs, labor costs, equipment costs, regulatory costs, everything is going up. And there's a lag time of 7 to 10 years between discovering a new deposit and bringing it into production. What that means is the gold supply is essentially fixed for the next decade. There's no cavalry coming. There's no surge of new production that's going to flood the market and bring prices down. Meanwhile, demand is exploding. Central banks are buying at record levels. We already talked about that. But it's not just central banks. Wealthy individuals are accumulating. Family offices are allocating. Sovereign wealth funds are diversifying into physical gold. And then there's the retail demand. In countries like India and China, where people have a cultural affinity for gold, demand has been surging. Chinese retail investors bought over 300 tons of gold bars and coins last year alone. That's more than the entire annual production of most gold-producing countries. But here's where it gets really interesting. The paper gold market is starting to show cracks. You need to understand how the gold market actually works. There are two markets. There's the physical market, where actual metal changes hands. And there's the paper market, where contracts and derivatives trade on exchanges like the COMEX in New York. The paper market is enormous. It's estimated that for every ounce of physical gold, there are over 100 ounces of paper claims on that gold. Think about that. 100 people think they own the same ounce of gold. This works fine as long as everyone doesn't try to take delivery at the same time. It's like a bank. Banks don't keep all their deposits in the vault. They lend most of it out. As long as everyone doesn't show up demanding their money on the same day, the system works. But what happens when people start losing faith? What happens when they want the real thing instead of a paper promise? We got a preview of this in March 2020. When COVID hit and markets were panicking, something strange happened in the gold market. The paper price of gold on the COMEX was trading at a significant discount to the physical price. You could buy a gold futures contract for $50 less per ounce than it cost to buy an actual gold bar. That's not supposed to happen. In a functioning market, those prices should be nearly identical because of arbitrage. But the physical market had seized up. Refineries were closed. Transportation was disrupted. And suddenly, people realized that paper gold and physical gold are not the same thing. The premium for physical gold spiked to over $100 per ounce in some markets. If you had paper gold, you couldn't easily convert it to physical. If you had physical gold, you could name your price. That dislocation lasted for several weeks before the system normalized. But it revealed a fundamental fragility in the market structure. And that fragility is still there, waiting for the next crisis to expose it again. Now, here's where this connects to retirees specifically. Most retirement accounts are entirely in paper assets: stocks, bonds, mutual funds, ETFs. Even if you own a gold ETF in your IRA, you don't own physical gold. You own shares in a fund that claims to own gold. And in a crisis, when everyone wants out at the same time, good luck getting anywhere near the stated value. I've seen this movie before. I watched it in 2008 when Lehman Brothers collapsed. I watched supposedly safe money market funds break the buck. I watched people who thought they had liquid assets discover they couldn't access their money. The system works until it doesn't. And when it doesn't, the people who own real assets are the ones who survive with their wealth intact. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. Worth checking out if you're in that situation and want to understand your options. Anyway, back to what's happening in the markets right now. The technical picture for gold is extremely bullish. We broke out of a multi-year consolidation pattern last year. We took out the old all-time highs, and now we're in price discovery mode, meaning there's no overhead resistance. No one who bought gold at higher prices waiting to sell and break even. The next major resistance level is around $3,000 per ounce. And based on the momentum and the fundamental drivers, I think we hit that level within the next 6 to 12 months. But here's what's more important than the price target. It's the reason behind the move. Gold isn't going up because of speculation or momentum trading. It's going up because the monetary system is being fundamentally restructured, because trust in fiat currencies is eroding, because governments have debts they can never repay, because the only way out is inflation. And inflation is a retiree's worst enemy. Let me tell you a story about what happened in the 1970s, because there are eerie parallels to today. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. Essentially, he defaulted on America's promise to foreign governments that they could exchange their dollars for gold at $35 per ounce. Why did he do this? Because the U.S. had been printing too many dollars to fund the Vietnam War and Great Society programs. Foreign governments, particularly France, started demanding gold instead of holding dollars, and the U.S. was running out of gold, so Nixon ended the gold standard. And what happened next? Inflation exploded. The dollar lost over half its purchasing power during the 1970s. If you were a retiree living on a fixed income, you got absolutely crushed. Your savings bought less and less every year. Your standard of living declined steadily. But if you owned gold, gold went from $35 per ounce in 1971 to over $800 per ounce by 1980. It multiplied by more than 20 times. It didn't just preserve purchasing power. It dramatically increased wealth. The people who understood what was happening, who saw the monetary system changing and positioned accordingly, they transferred wealth from the people who didn't. Now, look at today. We have government debts that are mathematically impossible to repay. The U.S. national debt is over $35 trillion. The interest payments alone are over $1 trillion per year. That's more than we spend on defense. How do you pay that back? You can't raise taxes enough. You can't cut spending enough. The only way out is to inflate the debt away, print more money, make the debt worth less in real terms, and transfer the cost to everyone holding dollars. This is already happening. The Federal Reserve's balance sheet exploded from under $1 trillion in 2008 to over $9 trillion at its peak. They've pulled back slightly, but it's still over $7 trillion. That's $7 trillion of new money created out of nothing. Where did that money go? It went into asset prices, stocks, real estate, bonds. Everything went up. But that's not wealth creation. That's monetary inflation showing up in asset prices. And now we're seeing it show up in consumer prices, too. The official CPI says inflation is around 3%, but anyone who actually buys groceries or pays insurance or fills up their gas tank knows the real number is much higher. Shadow Stats, which calculates inflation using the methodology from the 1980s, before the government started changing the formula, puts real inflation at over 10% annually. That means your purchasing power is being cut in half every 7 years. If you're a 65-year-old retiree and you live to 85, your money will lose 2/3 of its purchasing power if this continues. The retirement you planned for, the lifestyle you expected, it's going to cost 3 times as much in real terms, unless you protect yourself, unless you transfer some of your wealth into assets that maintain purchasing power during inflation. Gold has been the ultimate inflation hedge for thousands of years, not because it goes up in value, but because it maintains its value while currencies lose theirs. An ounce of gold bought a fine men's suit in Roman times. It bought a fine men's suit in 1920. It buys a fine men's suit today. The gold didn't change. The currency changed. That's what retirees need to understand. You're not speculating on gold going up. You're protecting against your dollars going down. And the dollars are going down. They have to. It's the only way the system can continue functioning with these debt levels. Now let me address something I hear all the time. People say, but gold doesn't pay interest. It doesn't pay dividends. It just sits there. That's true. Gold is not an income-producing asset. But here's what people miss. In an inflationary environment, the return on paper assets is often negative in real terms. If your bond is paying 3% and inflation is running at 8%, you're losing 5% per year in purchasing power. You're getting poorer, even though your account balance is going up nominally. Gold doesn't pay interest, but it doesn't lose purchasing power. In an inflationary environment, that's actually a positive real return compared to most fixed income investments. And here's another thing people don't consider. Gold is insurance. You don't buy insurance expecting to make money on it. You buy insurance to protect against catastrophic loss. If the monetary system continues functioning normally, if inflation stays moderate, if governments get their fiscal houses in order, then gold will probably just maintain its value. You won't make a killing, but you won't lose purchasing power either. But if things go wrong, if we get a currency crisis or a debt crisis or a banking crisis, gold could be the difference between maintaining your lifestyle and watching your retirement savings evaporate. That's not fear-mongering. That's risk management. That's understanding that the system has vulnerabilities and protecting yourself accordingly. Let me tell you about what happened in Cyprus in 2013. The banks got into trouble. The government needed a bailout. And as a condition of the bailout, they confiscated a portion of bank deposits over 100,000 euros. People woke up one morning and found that 10% of their savings had been seized. Just taken. Gone. If you had your wealth in physical gold stored outside the banking system, they couldn't touch it. You were protected. Or look at what happened in Argentina over the last few years. Inflation hit over 100% annually. The peso lost 90% of its value. People who kept their savings in pesos got wiped out. But people who converted to dollars or gold, they preserved their wealth. They could still buy the same amount of goods and services. These aren't hypothetical scenarios. This is real history. This happens regularly in countries around the world. And the United States is not immune just because we're the reserve currency. In fact, being the reserve currency might make us more vulnerable because we've been able to print money without immediate consequences for so long. But those consequences are coming. They're showing up in inflation. They're showing up in the dollar losing value against other currencies. They're showing up in foreign central banks diversifying away from dollar reserves. The wealth transfer is happening. The question is, are you going to be on the winning side or the losing side? Here's what I'm seeing from wealthy families and institutions. They're allocating between 5 and 15% of their portfolios to physical precious metals. Not paper gold, not mining stocks. Physical metal that they can hold or store in secure vaults. They're treating it as insurance, as a hedge against monetary instability, as a way to preserve purchasing power across generations. And they're doing it quietly. They're not announcing it. They're not making a big deal about it. They're just steadily accumulating while prices are still reasonable. Because they understand something that most people don't. In a crisis, you can't buy insurance. It's too late. The price spikes. The premiums explode. The dealers run out of inventory. I saw this in March 2020. Overnight, gold dealers sold out. Premiums went from 2% over spot to 15% over spot. And that was just a preview. That was a liquidity crisis that got resolved in a few weeks. Imagine what happens in a real currency crisis. Imagine what happens when millions of people simultaneously realize they need to own real assets instead of paper promises. The price won't just go up gradually. It'll gap up. It'll be unavailable at any reasonable price. And if you're trying to buy then, you'll be competing with everyone else who waited too long. That's why the time to position is now. Not when it's obvious to everyone. Not when it's on the front page of every newspaper. Now, when most people still think everything is fine. The retirees who understand this, who take action now, they're going to preserve their wealth. They're going to maintain their lifestyle. They're going to be able to pass something on to their children and grandchildren. The retirees who don't, who keep all their wealth in paper assets, denominated in a currency that's being systematically devalued, they're going to watch their purchasing power erode year after year. They're going to have to cut back, reduce their standard of living, maybe even become dependent on family members. That's the wealth transfer. From the unprepared to the prepared. From paper asset holders to real asset holders. From people who trusted the system to people who protected themselves. And it's not just about gold. Silver is even more interesting in some ways. The supply-demand fundamentals for silver are actually tighter than gold. Industrial demand is surging because of solar panels, electric vehicles, and electronics. Investment demand is increasing, and above-ground stockpiles have been drawn down significantly. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 85 to 1. Historically, that ratio has averaged around 60 to 1. When it gets this stretched, silver tends to outperform gold on the way up. In 2011, when precious metals were in a bull market, silver went from around $18 per ounce to nearly $50 in less than a year. It almost tripled while gold went up about 50%. I'm not saying that's going to happen again, but I am saying the setup is similar. Tight supply, increasing demand, and a monetary environment that favors hard assets. For retirees, a combination of gold and silver makes sense. Gold for wealth preservation and stability. Silver for potential upside and industrial demand exposure. But here's the critical part. It has to be physical metal, not paper contracts, not ETFs, not mining stocks. Physical metal that you own outright, either in your possession or in a secure vault that you control. Because in a crisis, counterparty risk becomes everything. If you own shares in a gold ETF, you're depending on the fund manager, the custodian, the banks involved in the structure. If any link in that chain breaks, you could lose access to your investment. Physical metal has no counterparty risk. It's yours. It's real. It's not dependent on anyone else's promise or solvency. That's why central banks hold physical gold, not gold ETFs. That's why wealthy families store physical metal in vaults. They understand that in a real crisis, possession is everything. Now I know what some of you are thinking. This sounds extreme. This sounds like doomsday prepping. But I'm not talking about the end of the world. I'm talking about the end of a monetary system. And monetary systems change regularly throughout history. The gold standard ended in 1971. The Bretton Woods system ended. The classical gold standard ended after World War I. These transitions happen. And when they do, wealth gets transferred from people holding the old system's assets to people holding the new system's assets. We're in one of those transitions right now. The dollar-based system that's been in place since World War II is being challenged. Not because of some conspiracy, but because of mathematics. Because the debts are too large. Because the printing has been too excessive. Because trust is eroding. And in that transition, gold and silver are going to play a crucial role. Not because I say so, but because they always have. Because they're the assets that survive monetary transitions. Because they're the assets that maintain value when currencies fail. For retirees, this isn't optional. You can't afford to lose half your purchasing power. You can't afford to watch your savings evaporate. You need to protect what you've spent a lifetime building. And the way to do that is to diversify out of pure paper assets and into real assets. To take a portion of your wealth, maybe 10%, maybe 15%, and convert it into physical precious metals, not as a speculation, not trying to get rich, but as insurance, as protection, as a way to ensure that no matter what happens to the monetary system, you'll be okay. Because the wealth transfer is here. It's happening now. And the only question is whether you're going to be prepared for it or caught off guard by it. The central banks are preparing. The wealthy families are preparing. The sovereign wealth funds are preparing. They're all moving into gold and real assets. Shouldn't you be doing the same thing? Look, I can't tell you what to do with your money. I can only show you what's happening and let you make your own decisions. But I can tell you this. In 15 years of analyzing these markets, I've never seen a setup quite like this. I've never seen fundamentals this strong, technical patterns this bullish, and institutional positioning this aggressive, all at the same time. Something big is coming. The smart money knows it, The central banks know it, and now you know it too. The question is, what are you going to do about it? Are you going to take action to protect yourself? Or are you going to hope that somehow, despite all the evidence, everything will work out fine? Because hope is not a strategy. Hope doesn't protect your purchasing power. Hope doesn't preserve your wealth during a monetary transition. Action does. Preparation does. Owning real assets does. The wealth transfer is here. Make sure you're on the right side of it.